Oh, hello. Welcome back to the continuing lecture in corporate finance. This is Dr. Jeff Holm, and this is the lecture in cash flow statement, which follows directly the lecture in the income statement and balance sheet. And in our previous lecture, in our previous class, which was on balance sheet, right? I also briefly mentioned that the balance sheet and income statement are basically the primary sources, the primary statements in the financial statements. And of course, primary source of data is a different thing. Primary source of data is basically referring to ledger and journals, but basically the data compiled from the ledger and the journals will be reflected, cleaned up and organized into two primary statements, which are balance sheet and income statement. But as opposed to the primary statements, I said cash flow statement or cash flow analysis is relatively a secondary statement. By saying secondary statement, I'm not saying it is, secondary in importance, but what I'm saying is it's more of an analysis compiled from income statement and balance sheet. So the primary statements are the sources of this analysis. So that's why I'm saying it is a secondary statement in that sense. Again, also in the previous lectures, I said you will need, when we did in the balance sheet and income statement, there was what they call horizontal analysis and vertical analysis. And I said, I don't like those names. Those names probably are the names they use in accounting, but the names are too superficial, just because as the basis for my disapproval of those names, it's so elementary. Just because you're comparing the balance sheets of two adjacent years, right? And they are, placed, they are, juxtaposed or placed, side by side, so that they are adjacent. So it would look horizontal. And just because it looks horizontal, calling it horizontal analysis is very, I would say, one-dimensional, right? Or at best two-dimensional. Now, actually, if it was named by an economist, it would be called an intertemporal analysis. Intertemporal meaning, the analysis between two time periods, right? Or dynamic analysis, because dynamic means involves time dimension, or anything for to change places. Or 1 year ago I wasn't here, or let's say you live in New York now, but a year ago you were in California. Now time made this change, right? So whatever is dynamic, in other words, when the time dimension is involved, right, then It's dynamic because there's motion, and as a result of the motion, there's a change in state, right? So that would be the way the economists would name it, but in accounting they would name it like vertical analysis, when you're looking at the each line item in terms of the uh, total assets, or net revenue, right? Um, that's one dimensional or two dimensional at best, right? Now, anyway, but even in horizontal analysis, you needed two balance sheets and one income statement. Remember that? Because it's inevitable, because you are dealing with change of all these line items over time. So you need a income statement, a balance sheet at time zero, and a balance sheet at time one, right? Or a balance sheet at the beginning of the year, or at the end, and at the end of the year. So they inevitably, right? Um, so it's intertemporal, and there is dynamics there, and then also uh, what's happening during this period, right? Over this period of 1 year, what has happened is recorded, right? The process has been recorded. It's all recorded in the income statement, right? That's why you need two balance sheets and one income statement, and it goes also for the cash flow statement. Okay, so what we need is cash flow statement is also known as sources and uses of cash, okay, or statement of changes in financial position. Shows where money comes from and goes to, and it's developed from two balances and one income statement. So to analyze where money has come from and has gone to, you need to adjust the net income for non-cash items, because net income is not necessarily all cash, right? Think about it. If you made a sale, and if all the sales revenue was in cash, then your net income, or EAT, will also be in cash. But your sales revenue are not necessarily all in cash. A lot of it is in accounts receivable, right? So you need to make adjustment for non-cash items. And you need to also classify what are the sources or uses of cash. So let's start with some personal examples. Suppose you're buying a car, and let's say Joe Jones is buying a car. So I said you need one income statement and two balance sheets. So there is one income statement and two balance sheet at the beginning of the year and at the end of the year. So at the end of the year, he had the gross income of 50K, and his expenses were 40K. So the net income is 10K, and this net income is all cash, right? Because this is a person, right? So in case of a person, right, your revenue is just your gross income, right? I mean, you're not selling anything. I mean, you're selling basically your labor, right? Labor income. So your income is labor income, all salaries. So it's all cash, right? Expenses all paid in cash. So this is exactly. So remember from the balance sheet and income statement. So this is like, if this was a company, this is net profit, right? Net profit, or EAT. And EAT is exactly, uh, you remember, is newly generated equity, right? Equity generated from operating activity, right? Remember that? Or, there are two types of equity, remember, paid in capital, paid in equity, and equity generated from operating activities like this, so, which is, net profit. So uh, this will affect, obviously, the equity position at the end of the year. Let's take a look at his, balance sheet. At the beginning of the year, he already had $10,000 in cash. That's his, uh, asset in the bank, and this is his own equity because he didn't come from any lender. It's the cash he already had. So his total assets. He doesn't have any car. If he had a car, the car value would be added, but he doesn't have a car, so zero. His total assets 10,000. He didn't borrow any money, right? So he doesn't have any debt, and all this 10,000 is his equity. His total assets, total liabilities plus equity at the end of the year is 10K. And at the end of the year, his cash holdings increased to 15,000, and we're gonna look at the reason for this increase. And he bought a car, which is $30,000 car, and the source of this $30,000. We'll also look into that. Of course, part of it is loan, right? Now, so his total assets is 45,000, and his 45 out of his 45,000, it looks like 25,000 was the loan, right? Then obviously the difference is 20,000, and out of this 20,000, which is equity, 10,000 was due to was the increase from the net income, which is purely equity. So his total liabilities and equity is also 45,000. They must be balanced, right? Total assets and total liability side must be balanced, right? That's why it's called balance sheet. Now let's analyze the cash flows now. First of all, his cash income by the end of the year, at the end of the year, 50K, he spent 40K for his living expenses, right? So his net income is 10,000. We already know that. And he bought a car for 30K, $30,000 car. So obviously he couldn't cover it with this, so he got a loan, but he got a $25,000 loan, right? So then all the cash he had was 45K, and 30K he paid, so net cash flow is 5,000. Okay, so think about it. Net cash flow of this 5,000 added to the beginning cash balance, it will end up in 15K. Okay, makes sense. Now, so this is also detailed in the reconciliation, right, section. The beginning cash balance, 10,000, right? Net cash flow, 5,000. Ending cash balance, 15K. So that's what it is. Okay. So this is very simplified and simplistic example. Let's make it a little let's elevate it. Let's elevate it a little. Uh, one notch up. So in the next scenario, we'll assume you already had a car and you traded it. You traded it with a new car. Okay. Uh, so here, buying and selling cars. Uh, Sally Smith and her two cars. Actually, uh, she saw she bought she sold her old car and bought a new car. So it's not two cars. Eventually, there's only one car. So in this case, take a look at her. Let's take a look at her income statement. Her income, annual income at the end of the year was 60K. Her expenses were 62K, so she lived beyond her means. So her net income was negative 2K. Let's take a look at the balance sheet. At the beginning of the year, she had already, $6,000 in cash in the bank. She had a car. She called it luxury, but $20,000 car is certainly not luxury. Maybe it was probably a $100,000 car when she bought it, but by the time she sold it, it's 5 years later, only worth $20,000 in the market. She didn't have any economy car, but during this year, she swapped it with an economy car, which is worth 9,000, right? So at the beginning, economy car value 0. At the end of the year, luxury car value 0, right? And 9,000 economy. So these are all our assets. This is our current asset, right? If you think about it, this is our current asset. This is our fixed asset, right? Current asset. Or this is non-current asset, or fixed. Okay, fixed asset. Now then, take a look at the liabilities and equity. This car loan of $14,000 is not a new loan, because why? You might think, oh, did she get a loan to buy this car? No, this is the loan balance that was already there at the beginning of the year. So this is the existing loan that she probably got when she bought this old luxury car, when it was new, of course. So she had loan balance of 14K, which is liability, and she has existing equity of 12,000. Okay. So her, total liabilities and equity is 26K, which is the same thing as 26K, right? And at the end of the year, her cash balance went down to 1,000, and her assets, and she swapped into an economy car, which is 9,000. So her total ending total assets at the end of the year is 10K. Now she sold a car. Maybe she sold it for 20,000, which is basically the market value that was I mean, this is book value basically, but we're assuming the book value and the market value are the same. I mean, if usually the book value and the market value would be different, and I explained this, before. So her, she must have paid this off with her the proceeds from the sale of her car. Okay, so no more car loan, and her equity went down from 12,000 to 10,000. So her liabilities and equity is also 10,000, so balanced out. So now let's look into what caused the change in cash balance and equity position, right? So we all know her net income was negative 2,000, and when you sell an asset, right, it's source of cash. Assets go down, but cash comes in, right? So she sold it for 20K. That was the source of cash, and she used 14,000 out of it to pay off her outstanding car loan, and then she used 9,000 to buy a new car, small car, right? So net cash flow is negative 5,000. Okay, uh, so this explains why there is, from 6,000 negative change. Okay, I'm gonna. And then we know where the negative change came from, right? So beginning cash balance, right? Net cash flow, um, negative 5,000. Ending cash balance, 1,000, right? It makes sense, right? Um, so this is uh, uh, the cash flow analysis of Sally Smith. And in this case, of course, there is no explanation why equity decreased uh, 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 by 2,000, right? There's no uh, if it is due to and that is the only explanation, right? Because her equity, part of her equity is, her net income is part of her equity. And since she had negative, right, uh, she had to draw it from, let's see if I can copy this. Yeah. And then that is the only source of, right? Okay. Okay. All righty. Now, um, let's. So here's something we have to establish, very clearly that if assets increase, then that is you're using cash, right? So in terms of uh, that means negative uh, cash flow, right? And if assets decrease, that means you're selling assets, right? If you sell assets, there's a proceeds from sale of that asset. So that's a cash inflow, right? Positive cash flow, right? so on, right? And if the liabilities increase, that means you borrowed money, right? So again, that's a cash flow, right? And then if the liabilities decrease, right, it's also obvious, right? That's negative cash flow, cash outflow, right? Because if you're paying off your debt, you're using cash, right? Okay. Now, so we all also I mentioned this in the previous topic that there are three activities that all the firms engage in, right? And operating activities, right? And investing activities and financing activities. Operating activities, it's basically a income statement process, right? I've been telling you, it starts from the uh, uh, sales revenue and subtracting all the expenses, and then stops at EBIT, right? Operating income, right? Investing activities, um, when those are the activities that the firms engage in to buy or sell fixed assets, right? Plant and equipment, or long-term purchases, um, and the sale or disposal of the financial assets that it was holding. Now, financing activity is the activities to support. Now, think about it. You have to raise uh, capital to uh, buy, right? Like fixed assets, right? So, or also it can, support operating activities too, right? To buy, raw material, inventory, right? To borrow money, pay off loans, sell stocks, right? Pay dividends. If you sell, borrow money and sell stocks, there is, inflow of cash, right? So usually the cash flow is very well captured and depicted in uh, this diagram, cash flow diagram, right? It's more like a circuit, electric circuit, right? So first of all, um, you need, first of all, think about it. When you start up, when you start up a business, you need to raise capital, right? So to raise capital, what do you need to do? You will sell stocks, right? Or sell bonds, right? And then the money comes in, right? The proceeds, right, comes in, uh, and you get the loan, right? So that comes in. Um, so that cash will be used to support operating activities. In other words, you buy inventory, right? Meaning raw materials, right? Uh, or if you're a retailer, I mean, in case you are a manufacturer, you buy inventory, um, materials. If you are a retail business, you buy, your inventory is finished goods, right? Merchandise, and then because you bought inventory, you have to pay. So pay the payables, right? So maybe you can use promissory note or get a credits purchase on credit, but it is only for a while. Eventually, you'll have to pay out to the vendor. So cash goes out. And also you have to pay wages because, workers. And wages are usually in the form of accrual. And we talked about accrual in the previous um, lecture. There may be time to come back on this, but I'm not going to go into this. And then, so by paying cash to employees, paying cash to vendors, you have raw material, merchandise, and you pay the workers, and then you produce or purchase the products. If you produce the merchandise products, if you're a manufacturer, but if you're a retailer, you buy from the producers, and then the sale happens next, right? And then you receive either cash or promissory notes, or it could be a credit sale, so receivables. But eventually they will pay, right? The payment of cash is deferred for 60 days, most commonly, but eventually you collect it. So then cash flows back, right? And cash flows back into the company, and they use that cash to pay dividends to the stockholders or pay interest to the bondholders or repay the principal. Make sense? And the sum of that cash goes into buying fixed assets, which is an investing activity, right? Buying fixed assets is an investing activity, right? And so that cash flows to the vendors, right? And then some of this cash goes into paying taxes. So that goes to IRS. Okay, makes sense? All righty. So they also have something similar, which is called, racetrack diagram. But this racetrack diagram is mostly about operating activity. Just like a circuit, right? And the racetrack is a circuit, basically. But this is mainly focusing on operating activity, and not much on financing activity or investing activity, right? Of course, financing activity is source of cash, but investing activity, which is not described here, is usually use of cash, right? And no wonder they are mainly focusing on the operating activity. All right, so it takes a lot of time to draw this, actually, not writing, drawing. But our time's up for this segment of the video. So I will shut the video. So we'll stop recording, and I'll see you guys in the next video.